It is a really tough environment the last couple of days. What is happening in Europe and elsewhere as well. Where are the bright spots for demand at the moment, Ben?
Well, thanks, Jonathan and Anne-Marie, for having me on your show. Indeed, it is a very tough environment. It's clear we are not out of the woods yet. But if I just look, first of all, at our company, the bright spots for the quarter are, first of all, quite a healthy cash generation of $10.4 billion, a very strong marketing performance. Actually, we had a record marketing performance this quarter at $1.6 billion. And if you look back for the last 6 months, I would say that after implementing really tough countermeasures in the first part of the year, we actually now see that these are working. Our financial resilience remains strong. And we are seeing also a lot more confidence in our delivery. So I think this was the moment for us to say we have more visibility, we have more confidence, we have a clearer direction of where our strategy is going. So we now need to update the market with it.
Good morning, Ben. But across the board for big oil, refining margins have been really, really tough. Some of them not even turning a profit. You have Germany in lockdown. You have France in lockdown. You have cases surging in the United States. Is it bound to get worse?
Well, indeed, Anne-Marie, refining is a tough business to be in. As a matter of fact, it has been for many years. And that's why we have been steadily concentrating our refining footprint to those positions that are really advantaged. There was a day a decade ago that we had 55 refineries. We now have 14. And today we are announcing that we will have 6 refineries going forward. And they will be refineries that are advantaged because they are integrated with chemicals, they're integrated with trading, optimization, increasingly biofuels, hydrogen, synthetic fuels. And we believe that actually is going to be a strong footprint to work from. But of course, our downstream business is very much dominated by our connection with the customer. We have a better marketing business than anybody in the industry, and that's where we are going to focus the future of our company on, the future of energy. And that starts from the customer working back. So I'm very confident about our downstream business, not because of refining, but because of our connection with the customer.
What about LNG margins? You were greatly impacted by them. We have seen demand surge in recent weeks, but do you think this is something that can be maintained?
I think LNG is, in the long run, of course, very much a bridge. It is going to be an important business for us, but also an important source of energy for a decarbonizing economy. We see still LNG growth strong in the range of 3 to 4% over the few decades to come. Of course, there's always seasonality effects, Anne-Marie, and of course, depending on how the winter plays out, depending on other events that may happen, you may have a certain degree of volatility. And quite often, of course, we're also able to take advantage of that. But at this point in time, we remain very confident in the future of the LNG business, and we intend to grow that business with the market.
Ben, one thing investors I'm sure are going to be excited about is your commitment to continue growing the dividend. But I have to ask, is there a catch to this? Is there at any point where you decide to abandon this plan, this progressive dividend, to continuously increase it? Because we did see you have to cut it earlier this year.
Yes, that was a very painful decision, but we thought it was a very prudent decision as well. And it was, of course, one of the countermeasures we felt we had to take at the time when we had so little visibility of what was going to happen next. So, indeed, resetting the dividend, but at the same time, bringing back our capital spend from what we had planned to be $25 billion and growing to where we are now trending to $19 billion and maybe even less. And on top of it, a significant reduction in operating cost. So that actually has reset the company. It has strengthened the financial resilience. It has given us confidence also that we know how our business performs in these difficult circumstances. So I think it is, again, with prudence that we now say, let us start increasing the dividend. If you have a progressive dividend, which is what we said back in Q1, and we are confirming today, it has to be progressive. And the board is confident that we can grow the dividend with 4% this year and with similar sort of percentages for a long time to come. So this is a new era we are talking about.
You're also committed to distributing cash back when net debt drops below $65 billion, we are not there yet. Everyone wants to know, Ben, when will that debt drop below $65 billion?
That's understandable, Anne-Marie, and of course it is very difficult to make forecasts on how the economy is going to play out, how the macro is going to play out. But indeed, we do want to reduce debt. We are very clear on our priorities. The first priority is to, of course, pay our progressive dividend, but also invest at a level that will preserve the value of the company. And the next priority is indeed to pay down debt, down to a level of $65 billion net debt that we believe is sort of at the threshold of a AA credit metric. Credit metrics that we are aiming for. When that will be is very much a function on how the economy plays out. If we see a very fast recovery, if there is a vaccine soon enough, if everything gets back to normal, this can be quite fast, as you can imagine, but it can also take a little bit longer. We're not doing forecasts on that. We don't forecast the macro conditions, and therefore people will have to work out for themselves when that could be. We give all the tools, by the way, for people to understand.